Hello and welcome to this video. We will continue talking about quantitative trading. Statistical arbitrage deals with the simplest financial instrument, stocks, futures, and sometimes currencies. One does not need an advanced degree to become a statistical arbitrage trader. If you have taken a few high school level courses in math, statistics, computer programming, or economics, you are probably as qualified as anyone to tackle some of the basic statistical arbitrage strategies. Okay, you may say, you don't need an advanced degree, but surely it gives you an edge in statistical arbitrage trading? Not necessarily. I received a PhD from one of the top statistics departments of the world, Cornell's. I work as a successful researcher in one of the top computer science research groups in the world, at that temple of high techdom, IBM's T.J. Watson Research Center. Then I worked in a string of top investment banks and hedge funds as a researcher and finally trader, including Morgan Stanley, Credit Suisse, and so on. As a researcher and trader in these august institutions, I had always strived to use some of the advanced mathematical techniques and training that I possessed and applied them to statistical arbitrage trading. Hundreds of millions of dollars of trades later, what was the result? Losses, more losses, and losses as far as the eye can see, for my employers and their investors. Finally, I quit the financial industry in frustration, set up a spare bedroom in my home as my trading office, and started to trade the simplest but still quantitative strategies I know. These are strategies that any smart high school student can easily research and execute. For the first time in my life, my trading strategies became profitable, and has been the case ever since. The lesson I learned, as Einstein said, make everything as simple as possible. Thought I became a quantitative trader through a fairly traditional path. Many others didn't. Who are the typical independent quantitative traders? Among people I know, they include a former trader at an hedge fund that has gone out of business, a computer programmer who used to work for a brokerage, and a former trader at one of the exchanges, a former investment banker, a former biochemist, and an architect. Some of them have received advanced technical training, but others have only basic familiarity of high school level statistics. Most of them backtest their strategies using basic tools like Excel, through others may hire programming contractors to help. Most of them have at some point in their careers been professionally involved with the financial world, but have now decided that being independent suits their needs better. As far as I know, most of them are doing quite well on their own, while enjoying the enormous freedom that independence brings, besides having gained some knowledge of finance through their former jobs. The fact that these traders have saved up a nest egg for their independent venture is obviously important too. When one plunges into independent trading, fear of losses and being isolated from the rest of the world is natural, and so it helps to have both a prior appreciation of risk and some savings to lean on. It is important not to have a need for immediate profits to sustain your daily living, as strategies have intrinsic rates of return that cannot be hurried. Instead of fear, some of you are planning to trade because of the love of thrill and danger, of an incredible self-confidence that instant wealth is imminent. This is also a dangerous emotion to bring to independent quantitative trading. As I hope to persuade you in this chapter and in the rest of this video, instant wealth is not the objective of quantitative trading. The ideal independent quantitative trader is therefore someone who has some prior experience with finance or computer programming, who has enough savings to withdraw the inevitable losses and periods without income, and whose emotions have found the right balance between fear and greed. The business case for a quantitative trading. A lot of us are in the business of quantitative trading because it is exciting, intellectually stimulating, financially rewarding, or perhaps it is only thing that we are good at doing. But for others who may have alternative skills and opportunities, it is worth pondering whether quantitative trading is the best business for you. Despite all the talk about untold hedge fund riches and dollars that are measured in units of billions, In many ways, starting a quantitative trading business is very similar to starting any small business. We need to start small with limited investment and gradually scale up business as we gain know-how and become profitable. In other ways, however, a quantitative trading business is very different from other small businesses. Here are some of the most important. Scalability. Compared to most small businesses, other than certain.coms, quantitative trading is very scalable, up to a point, of course. It is easy to find yourself trading millions of dollars in the comfort of your own home as long as your strategy is consistently profitable. This is because scaling up often just means changing a number in your program. This number is called leverage. You do not need to negotiate with a banker or a venture capitalist to borrow more capital for your business. The brokerage stands ready and willing to do that. If you are a member of a proprietary trading firm, you may even be able to obtain a leverage far exceeding that allowed by Securities and Exchange Commission Regulation T. It is not unheard of for a proprietary trading firm to let you trade with a portfolio worth of $2 million intraday even if you have only $50,000 equity in your account. At the same time, quantitative trading is definitely not a get-rich-quick scheme. You should hope to have steadily increasing profits, but most likely it won't be 200% a year, unlike starting a .com or a software firm. In fact, as I will explain later on money and risk management, it is dangerous to over-leverage in pursuit of overcoming riches. Demand on time. Running most small businesses take a lot of your time, at least initially. Quantitative trading takes relatively little of your time. By its very nature, quantitative trading is a highly automated business. Sometimes, the more you manually interfere with the system and override its decision, the worse it will perform. How much time you need to spend on a day-to-day quantitative trading depends very much on the degree of optimization you have achieved. For example, at a hedge fund I used to work for, some colleagues come into the office only once a month. The rest of the time, they just sit at home and occasionally remotely monitor their office computers, which are trading for them. I consider myself to be in the middle of the pack in terms of automation. The largest block of time I need to spend is in the morning before the market opens. I typically need to run various programs to download and process the latest historical data, read company's news that comes up on my alert screen, run programs to generate the orders for the day, and then launch a few baskets of orders before the market opens and start a program that will launch orders automatically throughout the day. I will also update my spreadsheet to record the previous day's profit and loss of the different strategies I run based on the brokerage statements. All of this takes about 2 hours. After that, I spend another half hour near the market close to direct the program to exit various positions, manually checking that those exit orders are correctly transmitted, and closing down various automated programs properly. In between market opens and close, everything is supposed to be as an autopilot. Alas, the spirit is willing, but the flesh is weak. I often cannot resist the urge to take a look, sometimes many looks, at the intraday's P and L of the various strategies of my trading screen. In extreme situations, I might even be transfixed by the huge swings in P and L, and be tempted to intervene by manually exiting positions. Fortunately, I have learned to better resist the temptation as time goes on. The urge to intervene manually is also strong when I have too much time in my hands. Hence, instead of just staring at your trading screen, it is actually important to engage yourself in some other more helpful and enjoyable activities, such as going to the gym during the training day. When I say quantitative trading takes little of your time, I am referring to the operational side of the business. If you want to grow your business or keep your current profits from declining due to the what's, who's, and why of quantitative trading, increasing competition, you will need to spend time doing research and backtesting of all new strategies. But research and development of new strategies is the creative part of the business, and it can be done wherever you want to. So, between the markets open and close, I do my research, answer emails, chat with other traders, collaborators, or clients, go to the gym, and so on. I do some of that work in the evening and on weekends too, but only when I feel like it, not because I'm obligated to. Thanks for watching. We hope you learn with our content. We will continue in next videos.